Retail investors hear the exact same story every single day. New orders, multi-bagger alerts, everyone screaming to the moon. The daily market feels exactly like a Bollywood blockbuster trailer, all massive hype and sensory overload. But after a few weeks, the hype dies down, the volume dries up, and the stock crashes harder than a big budget flop on a Monday morning. While retail traders are busy refreshing their social feeds and reacting to headlines, institutional money is looking elsewhere. They are reading the balance sheet. They are actively studying cash flow, debt, and operating margins. Relying on loud financial news and YouTube gurus is a psychological trap. It is a distraction designed to hide poor underlying business performance from the people buying at the top. To compete, we need a way to process that raw data without the emotional noise. We can use AI as a skeptical, emotionless forensic auditor. Most retail traders make an immediate mistake here. They ask the AI, "Should I buy this stock?" They want a magic crystal ball to do the thinking for them. The right approach is to ask one ruthless question. What is the market not telling me about this company? That single linguistic shift changes your entire posture. You stop being a passive consumer of financial hype and become an active, skeptical investigator. Let's investigate a fictional example, Zenova Mobility Systems. News channels and influencers call this the next giant in the Indian electric vehicle space. This chart contrasts the company's actual performance with its media hype. The massive spiking bars underneath represent media mentions and influencer videos. But notice the line chart itself. The actual stock price has traded completely sideways for 18 months. Look at the underlying data. The stock is trading at an extremely expensive PE ratio of 92. At the exact same time, FII holdings, the institutional investors, have quietly dropped from 18% down to just 11%. When a story is universally praised by the media, but institutional money is aggressively exiting, the retail investor is being lured into a liquidity trap. They need you to buy so they can sell. We deploy our first AI prompt to run a forensic analysis, asking it to ruthlessly analyze Zenova's cash flow against net profit and current debt. This dashboard highlights the AI's findings. Because of inventory pileups and hidden pending litigations, Zenova's operating margins have actually collapsed from 9% down to 2.4%. The company is printing glamorous marketing posters, but nobody is buying tickets. We then apply a second prompt to test their alleged market dominance. Mapping the business through Porter's 5 forces reveals severe weaknesses in supplier dependency and switching costs. Customers can leave easily, and cheap imports squeeze pricing power. Finally, we run a valuation reality check. At a PE of 92, the stock is priced for absolute perfection. If growth slows even slightly, there is zero margin of safety between current price and actual free cash flow. AI forensics strip away the aggressive marketing, revealing a vulnerable, low-moat business struggling with falling margins. Consider another trap, AI washing. Take the fictional stock Aero Fiber Cloud Tech. Its stock price doubled in 8 months simply because management added the words AI infrastructure to their investor pitch. The media hype was extreme, but beneath the surface, return on capital employed was actively falling, and the company's promoters were quietly dumping their own shares on the open market. Chasing tech buzzwords without verifying management behavior guarantees that retail investors are left holding the bag while the creators of the illusion cash out. Once we know how to tear down bad companies, we can use AI to identify durable wealth generators. We do this by applying the Warren Buffett framework. We prompt the AI to evaluate a business strictly for a 10-year hold. We ask it to ignore the daily news and focus entirely on the consistency of free cash flow, the simplicity of the business model, and the presence of a true economic moat. Utilizing this specific prompt forces a psychological reset. You stop reacting to dopamine triggers like a day trader and start evaluating assets like a rational, patient business owner. In modern investing, extreme hype rarely correlates with high quality. Successful investing in 2026 requires prioritizing the avoidance of catastrophic wealth destroyers, those specific stocks that can wipe out years of hard-earned capital. AI is a powerful tool, but it is not a savior. The biggest winners will be the investors who combine the skeptical, high-speed data crunching of AI with independent human judgment. Research deeply, think independently.